with the conflict in Iran and a lot of disruption around the world, the dollar is in jeopardy. And it's in jeopardy as in its place as the reserve currency. It's been fluctuating wildly in the market as to the value of the dollar and where are we and how does that affect us? And we have really the expert on this today on the Wealthability Show. We have Barry Eichengreen. Barry, I'll let Barry, you talk about your own background, but Barry is an absolute authority on this. And we're going to learn today why the dollar and the value of the dollar is important, not just from an inflation standpoint, but from an investing standpoint, from an overall place in the world standpoint, and what is hopefully what's likely to happen with it and what the consequences are of the conflict in Iran and the Middle East today. So Barry, thank you so much for joining us on the Wealthability Show. And if you would, give us a little of your background and what you're doing right now.
So Tom, thank you for having me. I am a professor of economics and political science, both at the University of California, Berkeley. I'll give you an alarming statistic. I have taught here for almost exactly 40 years.
That's
and
awesome.
An even more alarming statistic would be I was born and grew up in Berkeley. So I've been around the environs for a long time with
You're an absolute local.
I'm out in places like New Haven, Connecticut, and Cambridge, Mass, and Cambridge, England. You can hear the hints of other universities in those associations as well.
Awesome. And your book is Money Beyond Borders, which is great because that's what we want to talk about today. We're talking about the US dollar. If you would, first of all, how do you define both where the dollar is and its value vis-a-vis the rest of the world right now?
So the dollar remains not only the currency of the United States, but the dominant currency used in all manner of commercial and financial transactions around the world, even transactions that do not involve the United States itself. So a couple of numbers to give you perspective on that. The US accounts for about 20 to 25% of global GDP, depending on how you measure things. But the dollar accounts for more than half of all the foreign exchange reserves held by central banks around the world. The dollar is involved in 90% of all foreign exchange transactions that occur around the world. The dollar is used in half of all cross-border payments between banks and firms and governments. So even relative to the size of the US economy, the dollar punches far above its weight. It's kind of the go-to currency for agents around the world, just like English is the lingua franca for us as we travel internationally as business people or academics or tourists.
So why is that important? I know it's a really basic question, but the first thing we have to understand is why is it important that the dollar is used like that and the dollar has that much clout in the world?
Well, it's important to Americans, I think, for 3 or 4 reasons. Number one, sheer convenience that our exporters and importers can do cross-border business in their own native currency. They don't have to buy someone else's. They don't have to worry about exchange rate risk because all of their business is in dollars, both their income and their costs. So that renders them more competitive than they would be otherwise. Number two, historically, the US Treasury has been able to borrow at a lower cost than otherwise because there's this big demand out there in the rest of the world for US Treasury bills and bonds, which foreign central banks, governments, corporations hold as the bedrock of their international portfolios and use for their own cross-border payments. So that's a saving to US taxpayers in that the interest cost on the debt is lower than it would be otherwise. Number three, we get an automatic form of insurance in the United States when something goes wrong in the global economy. When Lehman Brothers failed in 2008, when COVID erupted in 2010, when the war broke out in the Middle East at the end of February, funds rushed into the dollar and into US financial markets because the dollar has historically been regarded as a safe haven. The market in US Treasuries is the biggest, most liquid market in the world, and there's nothing investors value more than liquidity when a bad thing happens. Other countries, when such events occur, suffer capital flight. Panicked investors rush out of their currencies and their markets and their countries. People rush into the dollar, so our market is supported. It's more stable than it would be otherwise. The dollar strengthens rather than crashing. And finally, if you think financial sanctions on bad actors are useful, our financial sanctions are more effective than they would be otherwise by virtue of the fact that other governments and bad actors more generally use the financial services of the dollar and the US banking system when they do international business. So we can impose a cost on them if and when we see fit.
So we saw the US dollar gain a lot of strength over the last couple of years, and then it seems to have dropped off. Can you kind of discuss about you know, and I don't know where you stand on this, where you think a strong dollar is important or a weak dollar is important. Of course, weak dollar makes our exports more easier to market, but a strong dollar makes our imports cheaper. So why has that fluctuated so much? Because it seems like for a long time it was just like on a steady rise, and then all of a sudden it just came way down, and now it's been fluctuating. Why is that, and what's the effect on actually on the U.S. economy as a result?
I don't think the rise or fall of the dollar year to year is high on the list of factors affecting the competitiveness of U.S. companies and of the U.S. economy. What matters are the skills and training of our workers, our investment in plant equipment, new technology. In other words, the efficiency of our capital and labor management, the other resources on which the economy relies. And somewhere further down the list is what the exchange rate is at the moment relative to last year. In terms of why the dollar weakened by about 10% in 2025, my reading of that is that it was mainly uncertainty about where US policy was going to go next. Remember, 2025 was the year of Liberation Day on April 2nd, and then there were tariff rises and tariff declines and big announcements about changes in US tariff rates. I think as well that questions about the independence of the Fed weighed on investor sentiment in the dollar. If the president is going to be able to fire Governor Lisa Cook or fire Governor Chair Jay Powell, and who knows what that will imply for US monetary policy going forward, foreign investors want to hedge their bets against that risk, and they do so by trimming their holdings of dollars, which weakens on the foreign exchange market.
Yeah, and thank you, because that leads into my next question, which is how does the strength of the dollar affect interest rates?
Well, I think if people think that the dollar is going to strengthen going forward, they find holding dollar securities more attractive than otherwise.
Which would pitch the interest rate down, right?
Security prices go up, interest rates go down. Exactly. So there has always been a relationship there, not between the level of the exchange rate and the interest rate, but what people think will happen to the exchange rate, how it will change. going forward. So if they think it will strengthen further, our interest rates are going to be lower.
Which for anybody who's an investor or a business owner is very important.
Indeed.
Um, and it also changes where money is allocated, right? I mean, cash is going to flow more into dollar denominated investments like treasury bills, right? If the dollar is actually, what's interesting is if the interest rate's down, they tend to flow away from treasury bills in a lot of cases because they're flowing into real estate and other assets that produce a higher rate of return. If the interest rates stay high, that's where all the money goes because if they can make, if you can get 4.5% on a treasury bill and you get 4% in the real estate market, you're going to take the treasury bill all day long, right? Because it's less risky.
So I think what you're saying is right, that if people expect the dollar to strengthen going forward, and that makes for lower interest rates on treasuries, that will spill over into more investment in other things, be it real estate or AI-related companies or whatever.
On the other hand, it does increase the cost of exports, right, to those who are buying them. So those industries tend to get hurt a little bit that are primarily driven by exports.
Yeah, but as I said before, I think that change in the exchange rate is not high up on the list of things that help or hurt companies when they tap into global markets.
Okay, so let's talk about the Middle East, and 'cause that's the big news right now, and the effect that it's having on the dollar. But before we get there, can we talk about Russia and Ukraine? Because I think that's where kind of we had that disruption first, right? And you were talking about sanctions, and we were very heavy-handed in our sanctions. It seemed to me more so than perhaps ever before on Russia when it invaded Ukraine. What do you think the consequences of that were? Do you think that was a positive thing? Do you think it had, and what specifically was the result of that?
I think it was important for the democratic countries of the West to stand up to this aggression by Russia against Ukraine. We were not prepared, I think, rightly to put boots on the ground, so we used our financial power rather than our military power. What was important was that we did it together with our allies. These weren't simply US sanctions, but these were sanctions in which the US, the European Union, the Japanese, and some others all participated. Russia was able to work around those sanctions to an extent by relying more on China and doing its business with China in China's own currency rather than going through the dollar as it had historically. So sanctions never work perfectly, and they didn't work perfectly in the case of Western sanctions against Russia. But I think that was important to do. In terms of the costs to which you alluded, I think other countries have paid close attention. And some of those who worry about the possibility, even the remote possibility, that they could be on the receiving end of US sanctions in the future have begun to look to alternatives.
Well, that's exactly where I was going with this is, okay, so what it seems like it scared a lot of countries that we could put those heavy-handed of sanctions on a country like Russia, which is not a small country, has a lot of power in the world. And then the smaller countries going, wait a minute, you could put those on us. So now you have more of this discussion in the BRICS countries. You have more countries wanting to join BRICS. And a lot of their reasoning for that seems to be, hey, we need an alternative. So where do you see that going? Do you see that continuing as a trend that the dollar becomes less important? Whether it goes away or not is, I think to me, practically that's a non-issue. But from a weakening standpoint, it seems like it does weaken the dollar's position in the world.
It does, but I would broaden the question, Tom, from the BRICS. to countries in general. So if you go to Europe, you hear European policymakers
Sure.
openly asking whether the US is still a trustworthy monetary and financial partner, whether their reliance on the US banking system and the dollar could be weaponized in the future. And they talk about the need to be more self-reliant in terms of their monetary affairs and rely less on the dollar and the US banking system for all their cross-border transactions. So it's not only sanctions, it's not only Russia and the BRICS. I think it is a broader issue, and that's likely to open up at least limited alternatives to the dollar in the global domain in future years.
And what effect do you think that'll have on the U.S.?
I think in a way it's kind of a natural development that emerging markets will continue to emerge. There is no reason looking forward decades why per capita incomes should be a third in China what they are in the United States. So these later developing economies will continue to begin to close that gap, meaning that the US over time will account for a gradually declining share of the global economy as emerging markets emerge. And it's natural that the dollar should account for a gradually declining share of global payments, global transactions, global foreign exchange reserves. If that transition is gradual and smooth, I think it'll be a good thing for the world and maybe even for the United States. Right now, the world depends for liquidity whenever there's volatility in the markets on the Fed. And so far, the Fed has been a reliable provider of that liquidity. In a future world where there are multiple sources of global liquidity, I think if the Fed falls down on the job, there will be other central banks that will be able to step in.
Interesting. Okay, so let's now turn to the Middle East. And here's my question. So the British pound used to be the reserve currency of the world. And Great Britain was an amazing empire. And it has gradually decreased, where now it's, it's important, but not all that important. And some of that, and kind of the nail in the coffin seemed to be their conflict with the Suez Canal. So my question is the Strait of Hormuz are the U.S.'s Suez Canal?
I worry that it might be. To put your Suez analogy in context, Britain came out of World War II very, very heavily indebted. So it needed access to foreign funds. It needed the confidence of global investors in order to keep its exchange rate and its economy stable. So when President Eisenhower disapproved of their adventure in Suez in 1956, he could effectively pull the plug on the pound sterling by telling the International Monetary Fund no money for the Brits. So I think part of the backdrop to thinking about what the wider impact of the conflict in the Middle East today could be is worries about U.S. Indebtedness, that the debt burden is high in the United States and it's rising due to 6-7% of GDP deficits, which show no sign of narrowing anytime soon. So we depend on the confidence of international investors. An important aspect of this is the bargain that Henry Kissinger reached with the Saudis in the 1970s, where the US agreed to provide reliable security services to the Saudis, and they agreed to do oil business in dollars and recycle their earnings into dollars into the US Treasury market. We got dollar stability, they got our security umbrella. Countries in the Middle East are questioning whether the United States is a reliable guarantor of their security, and if so, which countries exactly are we securing?
Right.
So that could have Suez-like negative repercussions at some point for the dollar.
So I think it's very clearly this is a really big bet that Trump has made. If he wins the bet, meaning he opens Hormuz, meaning he gets what he wants from non-nuclear proliferation in Iran. Probably not going to get a regime change. I think that's highly unlikely at this point. But if he gets that, then is everybody comfortable again, or is it the fact that he went in the first place, the negative?
Well, I think the fact that he went in without building a coalition of like-minded countries uh, uh, will be viewed as a negative by those like-minded countries. So I think the U.S.-Israeli war against Iran has again excited our European friends, made them think again about NATO and about their dependence on the dollar. So even what you're describing, Tom, the least worst outcome
Right.
in the Middle East, I think will end up accelerating to some extent diversification away from the dollar.
Now let's say that it is not the least worst, but is something not the worst, but something in between, and Iran stays where they are. How does that affect the U.S. and the confidence in the U.S. dollar?
Well, again, I think that would lead international investors and foreign governments to conclude that the U.S. had not planned for the necessary contingencies, and we couldn't be relied on to execute when we had geopolitical, but also a monetary or financial objective in mind. That scenario is bad for the global economy because the straits, as we've been reminded, are an important choke point. And if Iran can close the straits, it can close other choke points, and China can draw the lesson that it has rare earths as a choke point that it should deploy more aggressively. All of this would be bad for the United States, bad for the global economy. Conceivably, it could be okay for the dollar because other energy dependent countries could be affected even more negatively than the United States, which produces as much energy as we use. You know, much of what we produce, we export, and much of what we refine, we import. So we are linked into global energy markets, but we would be hurt less by the scenario you described than the East Asians and then than the Europeans. So maybe the dollar strengthens even while the world economy, including the United States, weaken.
Interesting. You make a good point that the dollar can't be compared to the dollar. The dollar has to be compared to all of the currencies, and it's always relative. It's always a relative position, right? Now, so Iran and actually Russia, it would appear, both of their strategies in their wars have seemed to be get the U.S. spend a lot of money without getting its objectives. Okay. What kind of economic pressures outside of the obvious inflation political pressures, what are the real economic pressures that Trump faces in this war?
Well, I think his recent budget proposal showed that defense spending will have to rise significantly going forward, and there's no sign of a willingness to um, pay more taxes to finance that additional spending. I think we had an exercise in the first half of 2025 called DOGE that reminded us of how difficult it is to reduce other spending by the US government, entitlements and the like. The federal workforce, salary of the federal workforce is a small component of the overall budget. So fiscal pressures first and foremost, with federal government debt in the hands of the public of about 100% of GDP and rising rapidly to the kind of levels we last saw in the aftermath of World War II. Financing costs are going up as well, what with interest rates having risen in the last couple of years. So I think fiscal pressures and the need to maintain investor confidence, given those questions, will become more pressing now.
Okay, so I have two final questions to ask you. The first is, we see neither party with any care about the deficit. It seems very clear. Neither one of them cares. What do you see as the consequences of that?
Well, I think this clearly imposes a burden on future generations, which are going to have to pay to service and roll over all this debt. So we're now in a situation where interest on the debt is actually greater than our defense spending. It's one indication of how that burden has gone up. And then there will be a growing danger of an investor strike, that investors decide this debt is too risky. We don't know whether the current or future administrations will put pressure on the Fed to buy up the debt. That will cause inflation, that will lower the value of U.S. Treasury securities. And if they decide this is a possibility, they could flee from those securities all at once, which would make for much lower bond prices, even higher interest rates, which again spill over to those other markets that we were talking about at the top of the hour.
Got it. Okay, so I'm a tax guy. I study tax policy all the time. What would you do or what should we be doing from a tax policy standpoint? Not that either party is really interested in doing anything. I mean, we've got the Democrats who they don't want it. They don't want to reduce the deficit. They just want to change who pays the tax burden, right? They want the rich, the wealthy to pay much more of the tax burden than they're already paying, where they currently pay the large proportion of it in the first place. The Republicans think that you can just keep reducing the tax rates and the money will just come in. But it doesn't matter to either of them because we can just, it's like the old Jay Leno Doritos commercial. We'll just make more. We'll just print more dollars. So where do you think the answer lies in all of this?
None of your listeners are going to be happy about what I'm about to say, but I think we can do some things on the expenditure side, like means testing Social Security. There's no reason that wealthy people should be getting big Social Security payments when they reach my age. So there are some economies to be found on the spending side, but I think the main action will have to be on the tax side, raising more revenue, which means closing tax loopholes, eliminating tax expenditures. If you compare the United States with other advanced economies, we are pretty far down the list in terms of the share of our national income that we raise in taxes.
Sure.
It's a fact that most European countries raise more taxes than we do.
We're a tax haven.
I'm not saying we should become European or build European-style welfare states, but I think we have to raise more tax revenues if we're going to live within our fiscal means.
So one of the things you're suggesting is disconnect the idea between you put money into Social Security and you take money out of Social Security, because just call it what it is, a tax, and disconnect it from who gets money out. Because if you're saying a means tested, then that makes it a pure tax and no longer is it I put money in, therefore I get money out.
Well,
right?
I'm not saying disconnect them entirely, but I'm saying
Disconnect
weaken the
them
connection at the top end.
disconnect them for the top for the top level. I get that. Okay. And then where would you raise taxes? I mean, you talk about loopholes. I spent 45 years studying the tax law. There's a lot fewer loopholes than people think there are. They're not really loopholes. They're actually incentives. So you're talking about eliminating incentives like bonus depreciation or oil and gas intangible drilling cost deductions. I mean, those are significant incentives that do actually, I know for a fact, do actually result in investment, and investment would pull back. And the reason and a perfect example of that is look at how much money is going into solar now than was 2 years ago. It's a dribble compared to 2 years ago. Well, 2 years ago, we had huge solar incentives. Okay. So are you suggesting a complete shift in the way the tax laws evolved? Because it's only been since really the 1960s that it's evolved this way. Before that, it was more raise revenue. But since then, it's become, let's use it as incentives. So are you suggesting to pull back from using the tax laws as incentives? I'm really curious about this.
Yeah, I am suggesting pull back on a variety of tax incentives of the sort you described. Fun fact for you, my first job out of university was to write the individual income tax code in Fortran, if you remember Fortran. So I kind of
really?
for my think tank boss's early primitive version of TurboTax. That's why I can still do my own taxes. I had to learn the individual tax code.
Interesting. All right. Well, this has been fascinating. Thank you so much. Again, we're talking to Barry Eichengreen. His book is Money Beyond Borders. I do think that a study of currency, of global currencies, and particularly the US dollar vis-a-vis global currencies, is critical to understanding what's going on in the world and to predicting what might happen and how do we prepare for what happens. So I'm going to ask you a final question, Barry. If you were an investor or a business owner, how would you prepare for potential different scenarios that are coming in the next few years? Because clearly the war is not going to go on forever and things are going to change. How do you prepare for that?
My PhD dissertation advisor was Jim Tobin, who won the Nobel Prize for portfolio theory. At his press conference, they asked him, at his Nobel press conference, they asked him, what did you win the prize for? And he said, for showing that you shouldn't put all your eggs in one basket. So I think that old advice about diversify because we don't know what's coming next remains good advice.
Interesting. All right. Once again, the book is Money Beyond Borders. We've been with Barry Eichengreen on the Wealthability Show. And just remember, when we really understand, we've got to understand the macro, not just the micro, because the macro drives the micro. And when we understand the macro, then we can think about, okay, what do I need to do? So what kind of actions is it going to take to make way more money and pay way less tax? We'll see you next time on the Wealthability Show. Thanks for listening to the Wealthability Show. If today's episode gave you a new perspective, remember this: the tax law is not your enemy. It's a roadmap. And when you know how to follow it, you can build real, lasting wealth. If you're a business owner or investor who's tired of overpaying taxes, the Wealthability Accelerator is your next step. You'll have the opportunity to work directly with me for 80% less than my standard rate. And I'll personally guide you through how to change your facts so that you can change your tax. Go to wealthability.com/bonus and apply today. Remember, it's not just what you make, it's what you keep.
This podcast is a presentation of Rich Dad Media Network.